I'm sitting down with Kris Sidial, who I've sat down with before. Last time we met in Las Vegas at the Equity Derivatives Conference. You sat down with Harley and myself. This time we're actually going to do this over Zoom. You're sitting from your office, and I'm sitting from one of my rentals in Marin County. Kris, you wrote a fascinating paper on 0-day to expiry options, right? Zero DTEs, to use the language of the day. And this is something that I've been talking a lot about. This is something that you obviously have spent some time digging in a much more systematic fashion than I did, actually going in and on a, effectively a trade by trade basis, saying, can we disaggregate? Can we figure out who's playing in here, et cetera? The paper is called Dispelling False Narratives About Zero DTE Options. Let me actually share the screen very quickly so people can see this. And it can be found on your website at ambrusgroup.com. Is that correct?
Yep.
All right, fantastic. All right, so Kris, before we get started on this, just very quickly, what is Ambrus Group? Who are you? What's your background?
Yeah, I'll give you the whole 30,000 foot view. So I'm
Perfect.
the co-CIO of Ambrus. Prior to joining Ambrus, I was a prop trader at two different firms. Then I went to a large Canadian investment bank. Spent 3.5 years there. Most of my time was on the exotic derivatives desk. So, we came together, myself and a couple of the other partners, and we said, hey, there's a much more effective way to trade tail risk than what we were seeing in the market, right? So generally, when you think of tail risk, you think of these firms that just buy puts and bleed for years. But we said, what if you use a lot of active trading, a lot of active flow trading to minimize the bleed, so that for the client, what you can have is a portfolio that is designed to have this really large return during market crashes and be very close to flat during normal market environments. So it serves as a much more efficient hedge, in our opinion, at least. So we came together, we put the firm together, and it's just kind of our job to have an idea as to what are the new potential systemic risks that exist in the broad market that could potentially create a tail event. And that kind of leads us right into the zero DT stuff.
So this is one of these things that people tend to struggle with in the tail hedging space, right? And I certainly have had my challenges with it. Anyone who has done this understands that buying long vol is inherently a negative carry event. One of the biggest challenges you have is creating enough return to offset that. Now, if I look at well-known players, for example, like Mark Spitznagel at Universa, they're known for their use of things like putback spreads, right? Where they will sell in near the money to buy multiple out of the monies. That's simply a way of defraying the cost, although that creates risk of much greater losses on small drawdowns than you would expect, right? You have to be very careful in terms of how you manage that type of exposure. Another approach is to basically marry it up within a long exposure. So theoretically, if the market is going up, you're offsetting the cost of being hedged. That's another way to approach it. But you're identifying something that I've worked with several people on, is this idea that your trading itself can create enough alpha so that you can offset the cost of carrying that hedge. Is that a fair characterization?
Yeah, absolutely. And we're not reinventing the wheel here. This is a very familiar type of market maker type of approach, right? So when you think of the traditional market makers that trade derivatives, it's usually this model where they say, okay, we want to make a little bit of money during normal environments and have the potential to have a very big return when things become dislocated, because we could reallocate to those assets. So that's pretty much the idea, trade a lot of flow intraday to offset this bleed and be inherently long the tail, so that when things hit the fan, you have this abnormal return. So very different than the type of trade structures that you hear about at Universa, but a very effective model that firms like Jane Street employ. So,
well, and so part of the reason why I want to hit on this is there have been challenges, I think, around the perception of, well, if you're good at trading, why wouldn't you just go long, right? And this is actually one of the obvious challenges that you have in our industry, and I do just want to take a second to emphasize this. There's a lot of really skillful traders that are very good at what they do, and they can actually be excellent at the long side of the book. The problem is, of course, the long side of the book has all the competition on the planet, right? So Kris Sidial might be one of the greatest long side traders in the history of the world. That, and as I like to joke, a quarter will get him a phone call at the last payphone in Manhattan, right? It'll take you forever to prove that to people. Once your track record is built, they'll then say, well, Kris, that's fantastic. You did it on $5 million worth of friends and family money, but we have no reason to believe that you can do it off of 50. So call us once you're at 50. And then once you're at 50, they'll say, well, that's great. You did it at 50. Why should I believe that you can do it at 500? Call me once you've done it at 500, right? And so there is ultimately an element just from a business model standpoint. And this is one of these frustrating things that people tend to forget about in this industry, is you actually have to build a business as well. And so what you guys are doing at Ambrus is you're taking those skills on the long side, combined with the experience that you've gained in terms of identifying relatively inexpensive hedges, to play the short side, offer a portfolio that actually offers positively convex payoffs to downside events. Is that a fair characterization of the
Totally.
business model?
Yep, you nailed it.
Yeah, I mean, this is the most frustrating thing, because people can often treat that with a degree of, skepticism. If you're so good at, well, the simple reality is there's not a business model for most long focused hedge fund managers if you don't come from the, pedigree that allows you to go straight into a Millennium or somewhere else, right? And so these are all very legitimate issues. I want to ask you one other quick thing before we go into the paper that you wrote, which is, this is a fairly quantitative paper and a fairly complex approach that you've taken to identifying stuff that I would by and large argue has been missed by most on the street as a mechanism for how to think about identifying these. For me, this was a lot easier, right? I just watched the behavior. I tend to operate under the dynamics of, what's called POSIWID, right? The proof of a system is what it does. Immediately, it became clear to me that anyone who thinks that people are out there buying 0-day to expiry options and trying to make outsized gains on day trading with leverage has no idea how markets work, right? I mean, the simple reality of options is that about 85% of options are going to expire worthless. The single best way you can raise your Sharpe ratio is by taking something that is going to expire 85% of the time worthless and increase the frequency with which you are trading it to expiry, right? Effectively allowing that roulette wheel to work in your favor on the dealer side. And so this to me was just one of the simplest things that was out there in terms of identifying this. But weirdly, that's not the narrative that came out. So maybe you can talk a little bit about the narrative that originally emerged around 0-day to expiry options, and also just very quickly, what is a 0-day to expiry option?
Yeah, absolutely. So a 0 DT option is just an option that's expiring that day.
Okay.
And what you noticed over the last few years is that the exchanges started getting a higher appetite for these type of products, right? So more of the market participants started saying, hey, we want leverage and we want, over shorter dated options so that we could express different type of views. And the exchanges started granting it, right? SIBO started listing these type of options, and the appetite pretty much skyrocketed. The interesting thing about what was going on was that when you looked at the actual price action, and if you follow derivatives, if you follow the flow, if you have any sort of quantitative data on this, you realize that it really diverged from what the mainstream media and the consensus from some of the larger banks and the research that they were putting out. Really what they were saying was completely well off. So when we looked at the data, we were seeing something, and then we were reading commentary coming from certain websites, certain banking desks, and it just didn't make sense at all. We said, how is it that we're seeing something? And obviously, as a hedge fund, we have certain coverage. So we have brokers that are on the floor themselves. You have electronic brokers that handle orders on your behalf, and they speak with you, right? So you speak with them, they speak with you. Word kind of gets around. And it was interesting because we said, this is so clearly wrong as to what these larger banks are putting out in terms of the directionality component of these trades, that it's surprising that nobody is discussing it. So we said, all right, let's actually dive into the data and put out a piece on it, because we weren't the innovators here. And Mike, to your point, this was something that you noticed as well. And you and I have not spoken on this at all, right? We didn't discuss it at all. There are other vol shops that understood this as well that we spoke to. And it's almost like everybody who was in the space and understands the space knew that the research was wrong, but nobody was saying anything. So we just happened to be the first group of individuals that came out and said, no, this is really wrong. And coincidentally, and I think this is quite funny, that as soon as we put out the paper, 4 weeks later, some of these same, larger banks came out and they were like, oh, wait, no, actually, people are not buying these options. They're actually selling the options. And the biggest sort of, the audacity behind it is that we can see who downloaded the paper, right?
Oh, God.
Right. So we know who downloaded the actual paper. So that makes the story a little bit funnier. But yeah, it was really surprising that the street was running with this sort of narrative for as long as it was, which was a good 4 to 6 months, pretty much.
Well, so you bring up a really good point, and we see this all the time. As you know, I do stuff with tier one on the data side as well. I spoke on this in a video, I think back in March, walking through exactly how this works, how you see, how you would expect this to play out from a practitioner standpoint without the level of detail. And so I do want to actually go into the detail of what you guys have done, because I think you are quite clever in this, and candidly, we're going to steal it ourselves. So it's and that is, like, I just want to emphasize that is actually a very standard practice on Wall Street. Everybody looks at everybody else's work. Everybody lifts everybody else's work. I do think there is a really interesting dynamic, though, that you and I had in a conversation off the desk, or off camera, about why this might be. And part of that is actually effectively the Chinese wall that exists between trading and research, right? You have to be very careful in a post-Dodd-Frank world about what type of information is being shared. Can you comment on that a little bit?
Yeah, absolutely. So if you work at one of these large dealers, like let's say a bank, and
like let's say JP Morgan. I'm sorry, go ahead.
let's say one of those banks, and you have the research side. So the investment banking side and the research side is going to be totally separate from the trading side. And there are quote unquote Chinese walls that are put up that the two cannot interact in that sort of fashion, because it could be a compromise for clients. And yeah, I mean, you know how things could get quite nefarious.
Unfortunately, I do, yes.
Interacting. So pretty much the research side doesn't really have the same knowledge that the trading side has. And some of the I guess you call it tactics that we refer to in the paper, it really comes with a trading understanding. Our partners at Citadel do, we come from institutional backgrounds. So we have an understanding in terms of how to look at data, how to source data, what the data means from a trading standpoint. But some of the people on the research side don't really understand that, especially in the derivative space where things could be quite opaque and esoteric. So you have this more generalized approach where they say, okay, 1 + 1 = 2, because this is our best assumption. And we're now going to make a whole model and a holy grail around it. And that's where things just go completely wrong, because if you look at the trading side in that desk, the trading side in the desk understands that the research was not in line as well. And I know this because we have spoken to some of the people on these desks. So it's a very interesting breakup when you think about the hierarchy and the structure on Wall Street, that you could have these large institutions where the research side is putting out something, but the actual trading desk itself doesn't necessarily agree with it based on, their knowledge base as well.
The point that you were making is that it requires this unusual combination of research and trading to be able to identify these sorts of things. And yeah, so that's really what you brought on the Ambrus side. That's the sort of fun part for me, is always, participating and having, both feet in the, fingers in both pies, the research side is the chief strategist and kind of market analyst, and the portfolio manager side. If you don't see both of those, it's really hard to figure this sort of stuff out. Now, what you guys did in this paper was, I thought, awesome. You actually recognized the way that they approached the research to come to the conclusion that zero DTEs were being bought. Let's start there. What's the traditional way in which somebody on the research side would disaggregate this information?
Yeah, totally. So, and you see this across a slew of different websites and research places. It's not just some of the banks, but it's a more generalized approach where they say, okay, if something is executed close to the bid, that means that the end user was selling. Or if something was executed close to the offer, that means that the end user was buying. And the irony is that when you look at the data, you see that there's a ton of trades that are executed right at the mid. So that skews when you're thinking like stats 101, that skews the data tremendously if you just make that sort of generalization. So you can't just go in and make that presumption. So, when you think of the way how market makers, and this is no surprise, happy to discuss this. When you think of the way how market makers on the derivative side trade, they mark their books to something called local volatility. So when you buy an option, there is a local volatility on that specific line of the option. Exactly, right? So the tenor, the strike itself has its own volatility. So when the market maker now goes and they trade, they're trading against that number, that local volatility. Something could be, bought or sold for a 8 vol, a 10 vol, a 15 vol. And at the end of the day, when they mark their P&L, they mark their P&L to that vol. So as the vols change, that is the activity that the market maker is participating in. So when you have an idea to know that, okay, these local vols have shifted on a large order and went up, that is a better assumption, along with a couple of execution tags that is a little bit proprietary, but I'm sure people could derive their assumptions on it as well. You could have the understanding that, hey, the market makers are raising their local vols in these areas. Generally, they're going to be sellers there, right? So the rate of change of local vol, along with a couple of other regulatory execution tags, could give you a cleaner look on the data than just saying, yeah, something's at the bid, something's at the offer, buy or sell, and just tag it that way.
So I'm going to try something here. I'm going to share my screen and show people what that actually means from a Bloomberg standpoint here. So just give me a second here. Sure. And if I screw something up in this process, Kris, please do not hesitate to interrupt me. So let's see here if I can get this to share properly. Okay, you should be seeing actually my Bloomberg screen telling us that the S&P is down 13 points. All right, we got a live screen here looking at a call option being executed right at the market. You can actually see this at 0.01% out of the money, right? And you'll also notice that the vol model here that Kris is referring to currently says implied. I'm using a simple Black-Scholes model, right? Now, that's a really easy model. It's one that people are very familiar with, and it's extremely helpful when you're thinking about theoretically creating a model. But when Kris is talking about using a local vol model, that's actually designed to do something totally different. It dispenses with this whole idea of a normal distribution, and it basically says, given how all the other options are priced in this local region, dispense with all the other features and figure out a price at which I can transact, not a price at which I can replicate under a Black-Scholes framework. Is that a reasonable way to frame what you just said?
Yeah, totally.
Okay, so now just watch what can happen to the price of that option as I switch to a local vol type model. It goes from 14,910 to, holy cow, it went to 227, right? So this is actually a totally different approach to the way that a lot of people would think about how options are priced, right? That there's this theoretical framework that works out there where this super thoughtful individual with an incredible math degree is, furiously working with his slide ruler. We're actually in most situations just trying to figure out where something trades. The first instructions I always send out to my team on the trading side, anytime I want to transact in an option, is confirm the pricing I'm seeing, right? I need you to check the pricing, make sure the desks are actually seeing the same pricing. that I'm seeing. So that's part of what you're highlighting. The second thing that I would say that's really unique about zero DTE options, at least at this point, is that they're exclusively indexed, with the rare exception today happens to be option expiry day. So you do have single stocks that have zero DTE exposure, but that's just a freak of nature effectively, right? And so the zero day to expiry options on a normal basis are exclusively indices. They're almost exclusively very close to the money. So these are hyperactively traded contracts. And so they behave very differently than, say, if I'm trying to buy a 3-month out of, 3-month tenor, 10% out of the money call option on Apple. The odds that when I put that order in with the dealer, that there's somebody actually there on the other side of that trade, Apple's probably a bad example, but certainly if I went to do the same thing on Delta Airlines, the dealer is not actually going to find somebody in inventory to cross with me on that. They're going to synthetically replicate it. They'll go figure out how to get rid of it at some point in the future. So they're going to use slightly different models to do that. So the biggest users actually, as I've seen it, this is, I think, one of the reasons why we see stuff trade at the mids all the time in the zero DTEs, is actually the market makers themselves, right? The Jane Streets, et cetera, of the world are transacting constantly in these things.
Yeah.
Does that feel fair?
Yeah, totally. I think the biggest end user, right? There's a very big difference.
Huge difference. Totally agree.
Market maker and end user. The biggest end user was actually wealth advisors. And there's a very interesting reason as to why it was the wealth advisor community, because when you look at what transpired in 2022, put yourself in the shoes of being a wealth advisor. So during 2022, stocks were down, bonds were down, and there was really nowhere to hide if you were a vanilla wealth advisor. So if you had clients, your clients were coming to you saying, hey, how could we make more money? And because of these sort of short-dated options, some of the advisors started saying, well, hey, we could participate in these type of yield programs. And some of the larger advisors started rolling out these sort of yield programs. And that started to become a chunky source of flow in this space. Now, outside of speaking to larger firms, and you and I have discussed the two, a couple of the larger firms over a call, that do participate and do this from an institutional standpoint, there are also tons of RIAs. And what I mean RIAs, I'm talking more so, think about the financial advisor in the Midwest that has $2 billion in AUM, all scattered across the board, that started participating in these type of programs. And that was a big source of the flow. So kind of going back to the whole sell-side research thing, it was even more fascinating to see how they came out and said, oh no, this is actually retail is punting around these sort of, and it was like, whoa, no, retail is such a small component of these zero DT options that it's funny that anybody would even say that.
Well, and but again, there's a couple of reasons why they're saying that, right? One is that these options are not traded in large size, so it'd be extremely unusual for me to put in an order for 10,000 DTEs or to sell 10,000 zero DTEs. They tend to trade in smaller lot orders, which oftentimes gets confused for retail because they're getting broken up, right? So, and part of that can just be something like dollar cost averaging, right? So let's do a whole bunch of trades over the course of the day. Again, improving that frequency. That Corey Hofstein, who we do a lot of work with at Simplify, we talk about this dynamic of rebalancing luck, right? So if I sell them continuously through the day, I get even a higher hit rate than if I did it all in one slug because of the path dependency. Yeah. So all of those are things that contribute to it. Okay, so now I want to dig into actually what you did differently. So the first thing that you highlighted was this issue of where the trades are happening. And I'm going to try to blow up my screen here, and hopefully this will come through. Give me 1 second here. Okay, so we're going to share the screen again. This is directly from Kris's paper. I encourage everyone watching this to go to his website, download his stuff, steal it, and present it as your own. But at least reference Kris in the process. Okay, so what Kris was highlighting is that the way usually people do this work is they'll say, is something trading at the bid or the ask? And what Kris pointed out is, wait a second, actually that means we're discarding all the stuff in the middle we're capturing basically 20 to 30% of the trades, and we're therefore labeling it on at X. Does that sound reasonable?
Yeah. Yep.
And so you were basically taking aim at this small difference between the ask or higher and the bid or higher. If something is happening at the ask, that means theoretically somebody's out there buying it, right? They're saying, I want this. What's your ask?
Yeah.
Is that okay?
Yep.
So that's where the narrative came from, at least in its overall component. But what you've done now is you've gone in, you said, wait a second, look at what's actually occurring, and you actually highlight this in terms of different times of day as well, that behavior is changing. This goes again to the point that I'm making about the frequency. This is looking at the time of day. Let's see if I can zoom in a little bit more. Oh, make everybody sick in the process. So the time of day in which these transactions are happening, and the moneyness in terms of the quote. Now explain what that means to people, the moneyness in terms of the quote.
Yeah, so the moneyness is an easy way to think about it is just in terms of how far out the money, right? So if you think of like 100 when you think of moneyness, think of 100 as the middle. That's the at the money.
Okay, that's the at the money.
Yeah, 101 would be 1% out the money on the call side, right, to the upside. 99 would be 1% down on the downside. So when you're thinking in terms of moneyness, just think of it normalized to percentage terms and the distance in terms of how far out the money. So 100 would be the at the money. And yeah, what the data really affirmed was that right at the beginning of the morning time, and if you scroll down, there is another chart that should do a better job. Yes, that one. So if you scroll to the left, I think there's the more generalized one. Right. Okay. So what that's also showing you is time of day and the directionality as to what's going on. So surprise, surprise, right at the morning time, people are just hoarding into this saying, hey, we want to sell options, right? That is really the activity that's going on. And you saw this from, and Mike, you and I spoke about this off camera. To your point, you saw this in the price of vol itself, because there's no way that people could be buying vol and vol is just constantly grinding lower and lower and lower. It just doesn't, markets just don't work that way. So that's what you noticed. And then what we continue to notice is that throughout the day, you would see these people, these end users look to cover these positions and then take speculative trades in the direction of the actual market itself. So let's say if the market was trending up, some of these institutions would say, cool, close the short vol positions and then maybe take another shot in a closer to the money fashion on betting in the directionality of the market. So that was really the aggregated view of what we noticed.
Okay, so now, and this explains a lot of the behavior that you would see. So if I enter into a market and I sell a put, right, I'm going to cause some degree, I initiate a new position, I'm going to cause some degree of hedging activity. If I sell a put, right, theoretically, I'm now long the underlying index. That in turn means that a dealer that's trying to replicate that has some exposure effectively to the market going lower. What's their reaction to that? How would they delta hedge that?
Yeah, so when a person who's thinking about the derivative impact, an easy way to think about this is just think about the opposite side that the dealer would have to take to their position. So in terms of a call, right? I know most people are very relatable to the GameStop, call gamma squeeze to the upside. In terms of a call, if the end user is buying the option, then the market maker is selling the option. And that means if the market maker is selling the option, that means that they're selling the call, they're going to buy stock against that. Right. So that's kind of
this. Right. And so this becomes part of the gamma squeeze dynamic, right? Because the ratio of shares, the number of shares that they're buying is determined by what's called the delta hedge ratio. That delta hedge ratio is determined by a couple of things. The biggest one, of course, being the moneyness of the option. And as they show up to buy that underlying to offset the risk that they've now taken by selling you the call option, they have to buy the underlying shares. that theoretically can push the price of the underlying up, raise the delta, force them to buy more underlying. And so this is one of the key things that has been happening in a market that I obviously think is increasingly characterized by inelasticity, meaning prices move a lot for relatively small changes in supply and demand, right?
Yeah, totally.
Okay, perfect. So now if I think about the underlying dynamic of I walk into the market and I notice that, it is broader, but it is generally characterized by selling puts. If I think about the diagram that you just highlighted for it, I can put it actually back up on the screen here quickly, just so people can see what I'm actually talking about. You'll notice the red here is the activity that Kris is highlighting. It tends to be slightly favored, particularly at the open, to selling puts. This is basically no different than a normal wealth manager, somebody who's long stocks, saying I'm willing to get long at a slightly lower price, right? So 2% out of the money with 98 moneyness. I get long the stock as the investor. What is the dealer's hedge against that?
Yeah, so if the dealer is now looking to take on that form of the risk, the dealer would take, again, think of this in this diagram form, they would take on the opposite side, right? So that means that dealer would be supportive to buy stock, right? So now the dealer is long the put because the end user is selling the put, so the dealer is going to be long stock against that position.
Absolutely right. So now we see an underlying characteristic where as the dealer is coming into hedge, this is pushing the market up in response to this. If there's a ton of this activity happening, paradoxically, the options are getting bought. That theoretically represents more people getting long synthetically because the dealer has to basically do it for you, right? By selling that put, you're actually kind of long the stock. The dealer has to take that exact trade that you would otherwise be doing to offset it. It can push the market up. Now, what happens when as we go through the course of the day and the dealer is now long that underlying stock, but the option is going to expire at the end of the day, right?
Yep.
So what has to happen at the end of the day?
So the dealer will now look to close that position, and this could be the affirmation to the price action that we have been noticing on screen. So, I know a lot of people who are even in the business don't sit in front of screens all day and trade. But if you do, you would notice that there's very repeatable type of price action that happens at certain times of the day where you may see, oh man, the market's going off a cliff, and then out of nowhere, it's almost like a pinball machine. And people are looking at this and they're like, how is this? What exactly is this? And to your point, Mike, throughout the time of the day, when dealers are looking to offset that type of risk that they were carrying for a certain time, that may be that type of price action that you're noticing where you may see somebody come in to buy, a ton of ES, and out of nowhere, the market just goes up and people's like, there was no news on this. Why is it that the market was going up? Well, because the dealer was offsetting some of his risk.
And we've all seen examples of this, but let me just pull up a screen here very quickly to see if I can. Of course, now my Bloomberg is getting ready to crash. My computer is really giving me a hard time today. Oh, there we go. Okay. So let's see if we can find a good example of this. There were several earlier this week. You can actually see an example of it today, believe it or not. But let's go back a couple of days ago to the start of this week. And you can see here exactly what Kris is talking about. So this is looking at E-minis intraday, right? Overnight, goes up, market comes into the open, it falls off, right? This to me would represent overwriting of 0DT expiry calls, right? A dominant situation in which people are saying, I'm willing to generate a little bit of income. If the stock that I own or the index positions that I own get called away from me, so be it. I think I'm going to try to fade this, right? So they sell a call option against their position. The dealer has to offset that by shorting the stock. That fades over the course of the day. We close at the highs, right? Rinse, repeat over and over again until an event occurs that suddenly makes those call options that have been sold go into the money. What happens here, Kris?
Yeah, so and just to be clear, I don't recall the exact gamma profile at that time, but let's
Yeah.
assume that was the case. Well, if the dealer is now short the call option, he is going to now need to buy stock. And that could lead to, in a hypothetical example here that Mike and I are laying out, that could lead to the market continuously going up as the dealer continues to hedge. And there are other people that talk about this dynamic as well in terms of what goes on during OPEX week. I mean, surprise, surprise, we're on an OPEX day today, and that was the price action that we witnessed leading up into this week, right? So there are other narratives that people could attach to these sort of things that sometimes are true, but there are other times where there is no sort of news going on at all, and you'll notice price action move like this out of nowhere. And it's very evident that that is the actual derivative flow itself that is creating that type of move.
Right. And so you hit on this, Chem Carson hits on it in terms of the dynamics, what's called Vega, Charm, et cetera, which are the decaying features of this. All of what we're talking about actually plays almost exactly to the point that you were just making, which is paradoxically, when there is no news, when there is no fundamental, effectively deus ex machina that can come into the market and force a position change, these mechanical features take on a life of their own. And then, of course, we construct narratives afterwards, right? And it becomes, the CNBC talking heads are then turning around and they're like, oh, well, people suddenly decided that the cost of capital was better, or Austin Goolsbee, pronounced his name wrong and everyone thought that was funny and therefore the markets went up, right? These are the sorts of things that we construct as a narrative species. Remember, we're a species that for thousands of years created a story, and some people out there are going to start screaming at the screen that this is still the truth, that, there's a golden sun god who transits the sky in a chariot to explain why the sun rises in the east and sets in the west, right? So we need these stories to tell us what's going on. But the point that you're making actually is something that I emphasize all the time. In the absence of something really happening, oftentimes it's just the mechanics, right? And it's when you create these sorts of things, like it creates a degree of predictability that forces us to construct all sorts of stories around what's transpiring. And by the way, to be totally clear, like Kris and I are constructing a story, it's just pretty well supported by the data at this point.
Yeah, totally. I think that is the biggest difference, is that the data that we have observed and other firms have observed and people that are in the derivative space have observed all tend to line up. And when you have, experts that are trading these things every single day, that have been doing this for, a long, long time, it's hard to refute that sort of evidence, especially when the derivatives market has been so polarized. This is something that I really try to drill into the head of anybody who's speaking about this, because it's so important. But what happened during 2020 was this big switch, because during March of 2020, well, a lot of larger institutions started saying, you know what, we should implement the use of options and option trading in our portfolio. And during 2021 is when all of those mandates were approved and went into process. So during 2021 was the start of this whole renaissance era of the options world. And it's, the data shows you, it's hard to refute that type of data when you see how many options are being traded, what are the institutions that are trading them, how they are trading them, the capacity which they're trading them. It's like if you are sitting here and you're saying, I know a lot of people on FinTwit joke and say, a lot of the option traders and the vol guys will say that, they'll attribute everything to reflexivity in the derivatives market, right? And I get that argument, because sometimes it's not. Sometimes for a fact it's not, right? Sometimes it is a different narrative that's pushing it. But when the whole world is bound by this sort of big elephant in the room, it's hard to refute that. And I was talking about the whole coverage thing. Like we have guys that are brokers that will cover us that are on the floor. And sometimes they'll write in the Bloomberg chat, hey, SPX, yada, yada, yada. And 5 minutes later, the market goes this way, right? So right after a large print, whether it's a call option or something like that, or some sort of collar or anything of that nature, the market's moving on that. That is telling you that's not really a coincidence, So it is interesting to see how impactful the derivatives market is becoming in this very short period of time.
Yeah, no, I think that's absolutely a perfect summary. And hopefully people enjoyed the opportunity to kind of walk through this in excruciating detail. Kris, you've been an extremely game and helpful guide through this process. I just want to emphasize for people, check out the Ambrus group, ambrusgroup.com. The paper that Kris has written, you've got a couple of other pieces up there that I also have loved. You're really providing a lot of contribution to the system. And if people want to follow you on Twitter, what's your Twitter handle again?
Yeah, it's KSIDIII. So
okay, fantastic.
Yeah. Type that in. Beware of the fakes, because I have a ton of fakes on there. So
yeah, no, we all do, unfortunately. But and again, Kris, thank you so much. I encourage people to check out your work. This is an awesome piece of paper. And I would just really reemphasize to people, make a point of seeking out people who are really backing up the work that they're doing with really rigorous analysis. That would not be me. That would be guys like Kris, who are the young energy bringers to the space. I just am happy that I get to share it with you guys. So thank you very much, Kris.
Thank you, Mike. I appreciate you guys having me.